Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul focus on the things you can control when it comes to investing: asset allocation, low fees, and managing taxes. Tax loss harvesting, when an investment is down, can help you grow your net worth more effectively over market cycles. But it works best when you use many securities, so that when some things are zigging, others are zagging. Direct indexing is the culmination of low fees and tax loss harvesting at the individual stock level. And now, onto our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Last week, we talked about kind of the methodology of the idea that can anyone outperform the market over an extended period of time? And kind of it was both questions on like, just is it possible, but also playing some statistics of trying to do that over and over. And one of the things we didn't really touch on was the impact of taxes. And this goes back to the methodology idea that if you're comparing to an index, the index doesn't pay taxes as it grows, doesn't pay taxes on the investments. So that you could kind of compare an index versus your own investment in an ETF in a retirement account. That'd be the closest thing. But even then, you have some kind of tax impact on either your savings, money going in, money going out. But for a taxable investment account, we're not really including that. So even like the S&P 500 ETF will have a dividend yield of 1 to 2%. It's going to pay out dividends like 1 to 2% per year. So while the index assumes that gets reinvested and grows, in reality, for an individual investor in that ETF, they get that dividend. Even if they reinvest it, they still get a 1099 from the custodian saying you owe taxes on this dividend. And realistically, most people reinvest that dividend, and so their kind of account balance tracks the index minus expense ratio, and the taxes owed for that 1099 comes out of their withholdings on their paycheck, or they get a slightly smaller refund come tax time, or they even owe out of pocket a little bit. So they kind of pay it from their checking account, from their income, not necessarily from the investment. So good methodology on taxes related to investment is a little difficult from that perspective. Most good research does try to account for this. And we're going to kind of examine that a little bit more of the opportunities and downsides of taxes related to investing. Because I think I agreed with Trishul's conclusion from last week that one of the big things in your control is just keeping your fees low. If you can keep your investment fees low, you're probably going to do better. And kind of you're not expecting anything more, but if you can keep your fees low, you'll do better over a long period of time. The other thing that can really help your investments over time is tax loss harvesting. And this is going to be a big thing we're going to talk about today, where if your investment goes through a volatile period, or you have an asset allocation where some asset classes are down while others are up, the tax loss harvesting, a good tax loss harvesting strategy, could actually make up for the fees associated with those investments, and theoretically could outperform the market. But again, it's kind of looking back to the methodology. It's like, but now you're not saving money on your investment account, you're saving money on your taxes outside. So now you got a bigger tax refund, or you paid less out of pocket, so your checking account gets bigger. But again, like the methodology gets weird, but this is one where if we can count for the taxes and a methodology and have a good tax loss harvesting strategy, in addition to fees, one, it's within your control and could theoretically improve your investment. I don't know, is return even the right word or the right phrase, but could improve your net worth over time more than just the index. So Trishul, do you mind just kind of start off? Can you define tax loss harvesting for us?
Yeah, happy to. And it's certainly an important consideration. So I think what we're trying to allude here is that what matters at the end of the day is not your return, but your after tax return. And your after tax total return, which incorporates your return for dividends and capital gains after taxes are paid. So it's great that you might earn 10% in 1 year, but if it's all short-term capital gains, then you might only be left with 6%, after you have a pretty hefty tax bill, and maybe even less depending on what state you're in. And what that means is if we're in a taxable account, we want to be sensitive to these concerns. So there are tax advantaged accounts like your Roth IRA, traditional 401k, where it's a different story on how taxes are handled there. They're sheltered from some respect from these types of dividends and capital gains. On the Roth, it's known as after-tax money. So taxes have already paid. Once money goes into those accounts, they can grow and then be pulled out tax-free after certain age limits and cutoffs. And then for the traditional IRA, that's pre-tax money, meaning before you pay income tax, the money goes in there. And then when you want to take the money out, the money is then taxed at your marginal tax rate. But while it's in that account, there's no taxes in terms of dividends and capital gains. So what we're talking about with tax loss harvesting is the notion of having to worry about taxes in a taxable investment account. So there's no advantage here from the IRS in terms of being able to shelter capital gains and dividends taxes along the way when you're holding investments. So that means a couple of things. One, you probably want to hold things for a longer period of time so that you can defer your taxes further into the future. However, there is some opportunity for some marginal benefit, and this is known as a strategy called tax loss harvesting. So the way this might work is, let's say you bought IBM for $100 and it has a spectacular year and it's doing well, but then it hits a down patch and it drops from $100 a share to $80 a share. So your one share is now worth $80. Now you're still holding on to this position and you think it's going to do better over the long term. So you hold on to it and then, you stay on top of it. And then 10 years later, it's back to $100. Now, over that time, it's gone from, like we said, $100 down to 80. Now it's back to 100. And if you sell it, you kind of, wash your hands free and you're like, oh, great, no taxes owed, no gains had. You did lose out to inflation, but that's a different story. But the point is, you didn't gain or lose anything. However, you actually had an opportunity to make a bit of a gain or defer your taxes a bit when it fell down to $80. If you had sold IBM when it was at 80 and then waited a month to buy it back, and let's say it didn't move, it stayed at 80, then you would have locked in this 20% loss that you could offset future gains with. So that's just how losses work in general. And the reason you're waiting 30 days is there's this wash sale rule where the government says you can't sell something immediately and then buy back to lock in this loss. You have to wait 30 days. So that's how losses typically work. And they can, again, be used to offset future gains. Now, the tax loss harvesting strategy, it tries to use this notion that you're going to be investing in things, even for the long term, and there's chances that they might dip down. So maybe there's an opportunity to sell those things and lock in those losses to offset future gains. And there's a way to do this so that you don't have to actually sit on your hands for 30 days for a particular security. you can actually jump back into a similar security, something that's substantially different in the eyes of the IRS, and then still be able to lock in that loss. So, you might sell IBM and you might buy Apple or Intel, and instead of waiting 30 days, you're out of the market for, a few minutes or seconds. Now, this can be done with indices as well, meaning you can sell an index like the S&P and buy a similar index that's not exactly the same. And that's how you can kind of pull this off with a strategy that's even buying and holding a basket full of ETFs, where at any given time, there could be opportunities to capture these losses to offset future gains.
Okay, so a couple kind of break down, define a few things. One, when we sell at 80 and realize the loss and we buy back in, let's say it doesn't move in over the 30 days, or we buy a IBM 2 that functionally moves exactly the same, just because a lot of this economic factors that will affect a computer company would also affect another computer company. That's why you buy that similar. So you, instead of IBM, using Intel or Apple. But let's say IBM stays the same. So we understand wash sale rules, but we're once you understand them, acknowledge them, we're avoiding them for the discussion. We buy back in IBM at 80. We now have a cost basis of $80. So we realized a 20% loss, but our cost basis is 80. So when it goes back up to 100 years in the future, and we sell at 100, we have that gain in the future. So worst case scenario, we realize that loss, we never use it to offset anything, and it carries forward, and we just offset the gain that we realize in the future. So that's our kind of worst case scenario, is that we end up completely neutral. Realistically, we can use that loss to offset other gains sooner. So again, deferring our taxes farther, or we can even offset against ordinary income at $3,000 per year. So we might realize that loss, use it a little bit each year, and we're reducing our ordinary income tax rate, and then eventually paying a long-term capital gain tax rate. So even if we don't use it directly, the same loss to offset future gain, in general, it works out better to harvest that loss when you can, because they do carry forward. So that was kind of one thing that I want to kind of make clear, is that yes, you could end up functionally the same, but that's your worst case scenario when you go through a loss harvesting strategy.
Yeah, that's a very good point. And the other thing that you also alluded to is there's different tax rates depending on your situation, in terms of the amount that you can lock in and defer versus the amount you might actually end up paying. Another one to think about is you might be able to lock in a short-term loss, and that might be able to provide you with a greater benefit than a long-term loss. That might be able to offset a short-term capital gain, and that might provide you with a pretty good benefit if you can pull that off. So you can kind of start neutralizing some of your tax burden over time, or just mitigating it and then pushing your tax burden into the future. So overall, if you owe, just in general, stripping all this away, if you owe $10 in taxes, it's much better to pay that 30 years from now than now, all else being equal, because that $10 will be worth a lot less 30 years from now than it is now. And you can take that $10 and invest it over the next 30 years and have it grow. So that's the principal concept we're trying to say. By deferring taxes, you let your investments grow for a longer period of time, and therefore hopefully soften your burden once you actually have to pay those taxes.
Okay. And kind of next level, going into kind of practical application of a tax loss harvesting strategy, where you talked about you could sell the S&P 500 ETF at a loss. You could buy another US large cap ETF, which, like our example of computers, this would be even closer. The all the stock market and economic factors that impact the S&P 500 are going to be incredibly similar to a Russell 1000. They both track US large cap, but their definitions are different enough that it doesn't violate wash sale rules in the eyes of the IRS, but their performance is going to be exactly the same. So if you see a really big drop in the S&P 500, you harvest that loss, you realistically don't want to wait 30 days because things can happen. You want to be invested in a comparable asset class. So a lot of times it's selling out of the S&P 500, buying the Russell 1000. And we actually saw this play out in 2020, where we saw a big downturn as a good loss harvesting opportunity. But if you had waited, it actually recovered so quickly that if you tried to wait to get back in to avoid the wash sale rule, you would have missed out. So that's why it is important, if you're doing a good loss harvesting strategy, that you have that alternative investment that you can move into. You want to keep your overall risk return profile, your overall asset allocation the same, but you want to harvest that loss and not be out of the market for those 30 days. So moving from one ETF to another doesn't violate wash sale rules, but now you're still invested, so you actually participate in that subsequent rebound.
Yeah, and it's one of the things where we talked a lot about how it's really hard to beat the market last week. And we've mentioned this many times. And this is one of the few things where it's not that you're trying to beat the market by outsmarting other investors. You're just trying to keep your tax burden in mind and use that to your advantage. And over time, there is a potential for this to lead you in a situation where you're better off than where you would have been otherwise.
Yeah, and this kind of going back to the idea of methodology and studies, there have been pretty good research that loss harvesting strategies can effectively make up for their fee for the platforms that charge that fee to implement this, and even outperform the kind of expense ratios of the ETFs, and theoretically could provide greater overall return than just the index. Now, again, I say all this is theoretical and methodology is important because it doesn't work every year. You need the downturns, you need the volatility, you need the losses to harvest for this to play out. So depending on the research, if you've done it over the last 10 years, you might have seen so much growth, say from 2011 to 2020, that the downturn in March of 2020 you didn't have anything down enough. You didn't have anything at a loss. You had a really, really high unrealized gain. You had a slightly less unrealized gain. So there may not have been a loss to harvest. But if you go back over a longer time frame, where now you include 2008, 2009, that was much more likely to have losses to harvest. And if you kind of expand the same methodology out further, we include 99, 2000, 2001, then the strategy looks even better. So it's acknowledging that the methodology is hard. It makes sense. When you look at these studies, they are trying to apply common sense. And if markets are up, then there's no losses to harvest, and the strategy looks like it doesn't quite work. But if you in peculiar periods where there is volatility, then it's taking advantage of that. It's one of those kind of, like we've talked about in the past, this like common sense of, if your markets are up, yeah, you've probably lagged the index by your ETF expense ratio or your platform fee. Okay, so just keeping your fees low. But when the markets are down, this at least gives you something you can do to take advantage of that. It's an action that you can take. It's one of those things within your control that will help your net worth grow over time. And again, it's like I said earlier, it's hard to associate the losses generated from the investments and the tax savings back directly to that account. So like trying to say, yeah, you might be able to save about 1% of the portfolio per year on average in taxes. That's kind of the best research I've seen. But it's more like you reduce your ordinary income tax bill, and people don't necessarily reinvest that tax savings, and also that 1% has to be over a longer time period to include those big downturns. So that's why I say I acknowledge that the time frame of the research is a big factor in coming up to that roughly 1% savings on taxes, but I don't think this is like a data mining or a choosing time periods. I don't think they're trying to massage the data to reflect what they're trying to show, because it makes sense moving forward. I think this is a replicable strategy moving forward as well. Stocks are not going to keep going up. Eventually, they're going to go down. And this is something, if you have that strategy in place, you're ready to take advantage of that. That's how you're going to help yourself over time.
Yeah, you bring up a good point. So basically, what somebody might think about in terms of the calculations in their mind is the trade-off between employing this strategy is likely going to cost some extra money, a certain amount of percentage to employ it. Mm-hmm. And what you're hoping is you get a relative gain that's higher than that percentage. And what might happen is over time, you might realize that during some markets where things are going up, there are not that many losses, then the amount of gain that you see may not offset that cost. But during the periods where there are those losses, well, then you might make up, those incremental costs that you've occurred over longer history, so that you're ahead. If you look at a whole market cycle, and that's maybe one way to think about it. So I think that's something to kind of keep in mind. And it's a very good point that you bring up. I remember when I first started looking into some of this stuff, and I remember looking at some of the white papers that were put out by like Betterment and Wealthfront. So these are two common robo advisors that try to employ these types of strategies at the ETF level. And their goal is to, again, try to capture these losses to give you an incrementally better return. And one thing I did point out when somebody asked me about this is, well, yeah, you look at that back test and a lot of it's gaining from 2008. And, mm-hmm. I was in the hedge fund industry at the time, and I don't even know if it's an inside joke, but basically the notion is you'll never see a back test that doesn't include 2008. Because it's just such a great opportunity for if you do something, right? Yeah. There's so much going on that you can figure out what, anything to do, and you'll just do the opposite of what the market did and you're fine.
Yeah.
And the second thing is you'll never see a back test that looks bad, because that's the point, right? And, it's easy to say that this will hit those too. However, I did have to admit that there is merit to this notion beyond just, throwing darts at a wall or coming up with something that might not be replicable. And the notion is, yeah, you're going to have to pay taxes going forward. That's the first thing you need, right? A tax situation. And the second is you're going to have markets that do go down. So the theory or the underlying requirements for this strategy to work are pretty robust. Those are not likely to change. And, the question is then going to be, will the benefit outweigh those costs from a full market cycle? And that's something that we have to think about.
That's fair. And I think the other thing to help keep in consideration, especially with Betterment Wealthfront, is it's not just looking at U.S. large cap, that any good asset allocation strategy will include small cap, international, emerging markets, depending on your risk tolerance and time frame, probably have some bonds in there. And so the loss harvesting doesn't necessarily need to occur just based on large cap. You may see your large cap just keep going up, but you might be able to do the loss harvesting on the emerging market side, where you switch from I think it's EFA, I forget, it's MSCI has an index and FTSE has an index for both international developed and emerging markets, where they are slightly different. I remember, I I think one of them classifies South Korea as emerging markets and the other classifies it as developed. Like it's something like very esoteric of like just the definition of the emerging market was enough that the indices were different, but functionally they're going to be the same. So you can apply the same loss harvesting strategy at each individual asset class. So each security that you own, that if it's down, there's an ability to harvest the loss. And so that's why owning, say, 8 to 10 ETFs to implement an asset allocation can work a little bit better than just owning a single allocation ETF. I do love those single allocation ETFs because they rebalance automatically and they make it very simple and their fees are really low. But the ability to harvest losses tends to make strategies like the Betterment or Wealthfront or other ETF asset allocation strategies work just a little bit better. We're adding a little bit complexity, admittedly, but the ability to harvest losses over time does tend to pay off. And you can start to break out things like large cap growth versus large cap value, small cap growth, small cap value. Your ability to kind of replicate the same overall asset allocation, generate those market returns based on your stock and bond mixture, but having the securities that will go up or down can help kind of match the returns on a pre-tax basis, but then on an after-tax basis, you could probably do better than just a single ETF.
Yeah, that's a very good point. We had mentioned in one of our earlier episodes the benefits of a simple target date fund as a strategy for investing. And it's something that, yeah, for a pretty simple situation, that does make a lot of sense. However, for an extra edge, this tax loss harvesting strategy can potentially provide a good benefit beyond just what you might be able to do with the target date fund. And, this is one of a handful of reasons why I prefer to, with my clients, break up a global portfolio from, just one investment like ACRI, which represents like the global market, and, kind of chop it up into smaller pieces. So you have this ability for things to be zigging and zagging, and you can take the opportunity to tax loss harvest as one good example. And being able to do that is, again, something that over time should provide an incremental benefit.
So kind of breaking down the components really helps create more opportunities. Like you said, for something's going to zig while others zagging, and you need at least one of those things to be down to harvest that loss. The next level of this strategy that's pretty new. It's the concept is probably only around a couple years, but the implementation is just starting to get out there. Is called direct indexing. And Trishul and I have had conversations in the past. In the past, it was more about the active versus passive, because there are managed accounts that have those higher fees, but I was arguing that their tax management could outperform a passive strategy. And so the main concept here is, instead of owning an ETF with the asset class, there are investments called separately managed accounts, where in the past would be, instead of putting money in a mutual fund, you would hire a mutual fund manager or a similar other money manager, and they're going to buy all of the stocks that they would in that fund for you in your account individually. So now, instead of owning one mutual fund, you own a couple hundred individual stocks. So it's kind of replicating the investment strategy that they would do in that combined fund, but it's in your account. They'll take care of the trading. But now, because they've broken down either that asset class or that combined pool of funds into 100 or more different securities, different stocks, now you have the opportunity to loss harvest at the individual stock level. Well, when you look at the S&P 500, it could be up. And so if your US large cap ETF will be up, there's no opportunity to harvest losses. But the dispersion of returns of the individual stocks that make up the S&P 500 is so wide that you'll still get the average return, but you'll have those individual stocks that are super outperforming, and you'll have the stocks that are super underperforming and actually at a loss. So with managed accounts, because you own the individual stocks, and if they have a focus on tax management, even when your asset class is up, there's enough individual securities to do the same loss harvesting. Now, they won't buy all 500 stocks in the S&P 500 because they'll need to have a few others to move into. So it might be, in our example, you actually do own IBM, and when IBM goes down, they sell IBM and buy Intel. You also own United Airlines, and when airlines go down in March 2020, you sell United Airlines, buy American Airlines. You own Coke, so when Coke goes down, you sell Coke and buy Pepsi. And the idea is that we have enough individual companies to replicate the overall large cap space. And statistics are pretty good on this, that you don't need all 500. You can do it with about a third of the stocks, as long as it's kind of spread across different sectors, so that different impacts of the economy on certain sectors will be likely impacting these companies more or less the same. And this I have seen play out, again, probably over the last decade, that these separately managed accounts were generating significant losses that it was making up for the fees that they were charging. Now, again, this was an active strategy, so the fees were on the scale of 70 to 100 basis points. They were trying to do a little bit of alpha, not that weren't able to kind of do that as much. They really focused on the tax management. The other hard part is to buy 150 different stocks just because of stock prices, and each one has to buy one share, you need to be able to buy that. It usually takes on the scale of $50,000 to $100,000 per asset class to be able to implement this. To hold 150 stocks, you probably need to have enough money, and to do a full asset allocation, large cap, small cap, international emerging markets, and then so on the bond side, you usually need on the scale of $500,000 to $1 million or more. And so that's why it's not a good kind of small starting off strategy, but it is that next level of tax loss harvesting at the individual security level. But again, throughout most of its history, this was an active strategy, and this was kind of informing the debate of active with loss harvesting versus passive. So Trishul, just kind of like the historical SMA case, the separately managed account case, do I kind of illustrate that well, that by owning the individual stocks, the loss harvesting is more readily available than at the asset class level by implementing ETFs.
Yeah, that makes a lot of sense. So the more instruments you have in your basket, the more chances that things will be zigging and zagging versus, less instruments. So yeah, you want more opportunities for things to be moving in different directions, and being more granular with your positions is something that can help achieve that goal.
Okay, so Parametric was the one big company that did a really good job with this, and they've been doing it for quite a while. So that is one money manager that I've used in the past. Again, has to be at accounts that are big enough. SEI is a custodian that also adds kind of tax overlays, but this has been pretty good. Other strategies kind of at the custodian level, sometimes if you had that a large cap growth and a large cap value custodian, or you had a small cap or a mid cap, as companies change within the index strategy, it's like, oh, this company grew large enough, it's no longer small cap, it's now going to be a mid cap or a large cap. some of the managers might sell out of that to realize, you know what, I picked this small cap company, it grew so much, I'm now kind of realizing my gain. With an SMA strategy, you at the custodian level, you could see that transfer from control from that smaller mid cap manager to the large cap manager, so that you don't have to individually sell that stock, but you are kind of following manager instructions. That was a kind of a lesser benefit. Usually the loss harvesting was a better one. But it was a way to just incorporate the idea that you own the individual stocks and then you're getting input from other managers on what to buy and sell. But that's kind of just another way that the SMAs help, but it's not necessarily as replicable or applicable moving forward.
Yeah, and you can imagine why there's a little bit more of an active component in these types of strategies than just, buying an index, or even the ETF version of a tax loss harvesting at Betterment, because you have all these instruments and there's a few decisions that have to be made that aren't purely algorithmic, but they could be turned into an algorithm. For example, you need to come up with some sort of methodology that's, not emotionally driven, that tells you, okay, there's 500 stocks in the S&P. How do we pick the 150?
Mm-hmm.
Yeah, there's some rules there. Like you can say, we're going to pick 150, like you said, that represent in total a high correlation to the overall 500. And again, you want to make some decisions even within those 150, even though there's a high correlation. You don't want to be overweight or underweight a particular sector or industry within the S&P. So you want to get good coverage. And these are decisions that they aren't fully emotionally driven, but they do have some sort of human component where somebody has to come up with this type of strategy where if you're having somebody go in like every day and say, okay, now what do we do? Now what do we do? Now what do we do? Then that's going to be pretty active. And then the other component is you also need to decide what's a good comparable to every security that you're invested in. Mm-hmm. And you can use statistics to come up with an idea that Coke and Pepsi are similar enough. But, if you're investing, if one of your stocks is like a grain company, then you want to make sure you get a similar grain company, in your back pocket if you need to sell it. So there may be some fuzziness there. And you can imagine initially this was more active, like you said, but it's possible that over time that this will get more systematically driven and more index-like, I guess, where, some of these decisions are more formulaic than a manager having to make day-by-day decisions about.
Yeah, and to answer your question, yes, that's exactly the case. They had to choose, in my example, United or American first. And right. Like they prefer it goes up. They want to pick the one that goes up.
Yeah, but how do you know?
Yeah, exactly. They had to choose Coke or Pepsi at first. They had to choose IBM or Intel, and that's where that active management came into play. But you're also right. The next level, kind of what I was alluding to, the next level is combining this concept that that by keeping fees low and removing the active management side, so just everything all the good research we've seen from the ETFs, with the loss harvesting and the owning more securities so we get that wider range of results. Our average stays the same, but we'll have enough that are at losses, is what's called direct indexing. So again, this is what I talk about. This concept has only been around for a couple of years. And in terms of actual implementation, it's really, really new just in the last few months. I've been using it for one new client that I've been able to invest just in the last couple months. It's one thing I'm going to try and incorporate more and more, but direct indexing is the marriage of this low cost passive indexing strategy with the benefits of the tax loss harvesting from the SMAs. And so now, instead of having that active management trying to provide an alpha, you are truly doing this on an algorithmic basis of using statistics to try and buy that 150 securities to replicate the S&P 500, but then also adding in the loss harvesting available to you that at the individual security level. And so far, again, kind of going back to the methodology, so far, this has been exactly what I'm looking for from investment strategies. It's two of the things that are in our control when it comes to choosing investments and a good strategy are keeping fees low and managing for taxes. If markets go up and all of our asset classes go up, great. We're benefiting. Our fees are low. We're participating as much as we possibly can. If markets go down, we have a strategy in place that will help harvest losses to either offset future gains or help save on our taxes, and our net worth improves. And that's what I love about this. And so I want to try and go into a little more depth on direct indexing, but it's that the combination of the two things we can control when it comes to investing. Active management and outperformance is outside of our control. Market goes up, market goes down, outside of our control. Interest rates change, affects our bond prices, out of our control. But these are two things that are within our control that both have positive benefits and kind of both back testing and moving forward makes sense when it comes to the methodology. The theory is there, the application is there. It makes sense that these strategies will work moving forward.
Yeah, it's good to know that, we've rattled off so many things that don't work. I'm glad that we can talk about something that actually we have some conviction in that might make sense.
Yeah, and so again, I use SEI as a custodian. They have done this themselves, where they are going to look for, again, that basket of securities. It's going to be algorithmic, statistically driven to replicate the S&P 500. So they need enough on the kind of enough sector exposure, and they're going to buy. Again, it takes about 150 to replicate large cap. I think they do it for all US. It takes about 250 securities. They do it for international developed. It takes about 150 securities, and they're going to be able to keep their costs low, and kind of as low as realistically possible without going directly to just an ETF. The costs are on the scale of Betterment to Wealthfront. So Betterment Wealthfront, it's like 25, 30 basis points, I think, as a platform fee plus ETF expense ratios. Does that sound right, Trishul?
Yeah, depending on your exact situation, but that's the ballpark. Yeah.
Yeah. So, and that's kind of realistically, when I think of fees and platform fees, if you're adding a loss harvesting program, and you're not trying to do it yourself, but an investment strategy will be able to replicate it, so you don't have to pay attention every week of the year. That's what I think is more or less the cost, about 25 basis points plus ETF expense ratios. So it's I think we've seen this play out. Like even I think Schwab was doing this in Vanguard, where if they tried starting off lower, but it looks like most custodians have kind of was congregated around this fee. They've all kind of concluded or
Gravitated.
Yeah, there you go. They've all gravitated towards that approximate cost. That to implement this well as at the custodian level, that's probably about the fee. And for SEI strategy, while they're the first $500,000, their fee is 40 basis points. The next 500,000 is 27, and then it's 25 down to 18 basis points below that. And again, getting back to the SMA conversation, because it takes so many securities to implement this well, the minimums are on the scale of that $50,000 to $100,000, and so it really wouldn't make sense for a portfolio that's only $50,000, because that's, you only can pick one asset class. To have asset allocation is still the most important thing. That mixture of stocks and bonds is the most important thing in terms of your returns and the risks you're taking on. But once you decide the asset allocation, it's so important. That's why I also have no problem with Trish's idea of the target date funds or using an allocation ETF inside a taxable investment account. Asset allocation is more important than loss harvesting strategies. Would you agree with that, Trishul?
Yeah, I would. The way I kind of think about it with my clients is I have this kind of pyramid that I show, and the base of the pyramid is just a long-term buy and hold tax efficient investment portfolio. And yeah, once you have a good foundation, then you can kind of build upon it. And then the next levels add an incremental benefit. The next level above that is I have a global asset allocation. So the notion there is you want as much exposure to things that are zigging and zagging. And the portfolios that I target have 15, 20,000 different securities. And that means just a lot of things that can help benefit. And when something's doing good, something else might be doing bad and vice versa.
Yeah.
But yeah, having the ability to tax loss harvest is one of the things that are, higher up on that pyramid, but it's one of the things that can add, gravy, assuming you have a good foundation below you.
Yeah. Yeah. And so, again, with the direct indexing strategies, there's no ETF expense ratio anymore. You own the individual stocks, so it's just that platform fee. And so at $1 million, it's going to be a 33 basis point cost. And that's, again, right in line with the robo advisors who are trying to do this automatically. And so I do think that we'll see this more and more in the future. It's one, the fee feels about right. Some programs might be able to undercut the fee, but when the robo advisors started, they were charging less and they had to bring their fees up to kind of maintain profitable businesses. Vanguard and Schwab and Fidelity, that they seem to be gravitating about a similar fee. So I think that the fee is reasonable again, but there's no ETF expense ratio. But it does take probably at least 500,000, not at least $1 million to implement this. And so I think that's probably the thing that we'll see moving forward is there might be programs that could bring those minimums down. There will still be some kind of minimum because to own all the securities, you have to have enough. To buy one share of Amazon is $3,000. So if you want to buy 10 shares, that's already a certain amount that you're investing in Amazon kind of thing. But we've already seen other investments. I think Robinhood's able to do this, where you're able to buy partial share class or partial shares. So I don't. Do you have any kind of input on where investing technology is in terms of owning partial shares?
I think it's permeating through the industry. At this point, for example, there may be a few brokers, and then I'm pretty sure it's going to be standard and at some point in the near future. It's one of the things where a lot of stuff has come together to make these types of strategies more and more sensible. As you had mentioned, there's been a lot of systematization. There's also the ability to, have these separate accounts with so many moving pieces in a manner that's kind of streamlined enough so that somebody can get it done. Frankly, even at a couple 100,000 is pretty neat that it's possible these days. Of course, what's also helped is the fact that the commissions on the actual tradings have gone down to pretty much nothing. We've mentioned in the past that there's been a race to the bottom there as well. So it's been a lot of these things combined. And then, as you said, a few more things that once they get lined up, I'm pretty sure these types of strategies are just going to be more and more common over time. It's one of those things where, maybe 5-10 years ago, a tax loss harvesting strategy was a lot more academic. You heard about it. Everybody maybe was talking about it if they're closer to the industry, but now you're actually seeing a lot more practical applications. And certainly it seems like it's a good thing. It's adding innovation and value in the right places, in my mind. As you had said in the way beginning, this is one of the things that you can control. You can control and understand your tax situations. And if it's something you can do, then it may make sense to do it.
Yeah. that's a great point about the kind of the race from the bottom in terms of commissions. Just trading technology has improved so much that trading costs have gone down so much. And so I could see some marginal improvement on that kind of that 25, 30 basis point cost for a good loss harvesting strategy. I think there's enough competition there. I think that the ability to buy partial shares will bring the minimums down. So you could probably get to a point where with something like $50,000, putting together a 60-40 portfolio that's still using partial shares of these direct indexing strategies. Off the top of my head, I don't know how it work on the bond side, but kind of owning partial individual bonds. But again, I think that's still we've already seen that the financial industry has been able to slice and dice bonds and create new bond investments, and they've gotten pretty creative. So if they can kind of both be profitable as they go down in terms of minimums, I think that we'll get there. And I do think that this is kind of cutting edge. It's only going to improve. But it gets, again, it's that combination of low fees, because there's really good academic research and in practice that keeping your fees as low as possible helps you in the long run. But this is the next level in terms of helping with the taxes.
Good stuff, Aaron.
So I've been excited about this. Kind of on a personal note, I've been using SEI for a long time, in part because I can push them to try and implement things like this. I have just a good communication strategy, and that they have been receptive to listening to the advisors they work with. So when I first heard about the research on direct indexing a couple of years ago, I made sure to push them. So I'm not going to take credit for this. There's a lot of really smart people there. I'm sure they saw the same thing, but it's that idea of, yeah, that they're going to keep moving forward, and this is the next level. And so I'll keep paying attention, kind of trying to think of like what's the next level after this in terms of investing, but it'll keep coming back to not trying to do things that are not replicable moving forward.
Yeah, it makes a lot of sense. And I'm again, we're really glad we got to talk about something that we both feel can add value in the investing space besides just, kind of sitting on our hands. And
yeah. That's a great point. It's so much more conversation like, nope, this doesn't work. Nope, this doesn't work. Nope, this doesn't work. Yep. And I was like, wait, this works. We're not 100% sure, because we're never going to be that confident. It's like, we're pretty sure this works, and okay, we can start using this.
Yeah, it's definitely something that I find is useful in my practice, and I'm glad that we have the ability to provide value from these things, and hopefully kind of shift the game away from some of the things that are less proven and less likely to provide value.
Yeah. But yeah, I love our conversation today. Thank you very much.
Thanks, Aaron. I enjoyed it very much myself. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical, as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.